UBS just broke protocol. They don't admit metal moves are real. They admitted it. Target lifted toward $85, triple digits not dismissed. And the reason burns through every hedge. Physical inventory is vanishing while policy risk climbs into 2026. Paper markets can scream all they want. Only metal settles. This is where it gets dangerous. A major bank published a note saying this rally isn't speculation anymore. It's shortage. China locked export licensing tighter. Gold got repriced by central bank accumulation. Translation: the old playbook is dead, and 2026 is a different regime. If you've been watching silver fight invisible resistance, you've been watching the right thing. It's fighting the gap between what's on screens and what's in vaults. We're going to strip the signal from that note, show you why $85 isn't the story. It's the threshold, and arm you so the next whipsaw doesn't eject you. Start with the language. Banks don't casually say physical. They don't casually say policy risk. They don't casually say gold is repricing. Those are supply chain words. Casinos run on sentiment. Supply chains run on whether the metal exists or it doesn't. UBS is saying the driver stopped being trader emotion. It's deficit with policy fuel. Metal leaving faster than replacement while China chokes the valve. That combination doesn't trend smoothly. It gaps. It whips. Some days feel like trapdoors. 3 things you need to lock in. 1. This rally is real demand, not just financial demand. 2. China's export controls turn tight into fragile. 3. Gold is the flare, and silver doesn't stay quiet when gold moves. When physical tightness is real, you see it in the cracks. Spreads between markets don't behave. Premiums ignore logic. Price drops look brutal on the chart, but the buyer who needs metal doesn't flinch. Paper falls, street price holds. Paper is a screen. Metal is a shipment. When shipments are tight, every dip becomes a feeding window for the people who actually use silver, not speculate on it. Industrial buyers don't ask if it's overbought. They ask if they can source it. That question makes the rally structural. Export licensing out of China is not news. It's a throttle. People think exports flow like water. They don't. Exports are a valve. Tighten the valve while demand holds and pressure builds. Price doesn't float. It snaps. It jumps. It punishes hesitation and weakness. UBS expects volatility not because traders are manic, but because supply becomes irregular. Metal moves where it's allowed when it's allowed. Stop asking if silver is expensive. Start asking if silver is available. Availability is the real price. Gold has been moving like it entered a new valuation regime. Central banks loaded. Macro fear-fed bids. UBS nudged their gold target higher, toward $5,000, with the idea this trend runs through 2026 before cooling. Gold is the anchor, silver is the spring. When the anchor shifts, the spring eventually snaps into alignment. Not gently, but it does. That's why $85 matters. It's not a target. It's the bank saying the tension is still loaded. Here's the mistake. People hear $85 and think, I'll buy and wait. That's not a plan. That's hope. Tight markets don't climb stairs, they climb cliffs. One day looks stable. The next candle looks like it got hit by a truck. So what's the framework UBS pushes to their wealthy clients? They don't say buy silver, they say sell puts. Translation: if price drops here, I'll buy there, and I get paid to wait. It's discipline with income. Notice the levels. When silver was in the 30s, strikes were lower. When it hit the 50s, strikes moved up. Now with silver in the 70s, they're pointing around the 60 area. That's the pain zone where pullbacks could land without breaking the bigger structure. Where does it break if we're wrong? Not in headlines. In pullback depth and recovery speed. Does the market retest the shelf and hold, or slice through and stay below? That's the stress test. There's a zone in the low 70s acting like a floor. Call it the ledge. Every time price leans over, buyers appear. Not because they love charts, because they need inventory. Above the ledge, the tape gets emotional. Shorts cover, momentum chases, spreads pull. Below the ledge, the market goes quiet. Then real buyers either step in or they don't. If they step in, you're watching accumulation, not distribution. About triple digits. UBS raised the target near $85 because they think tightness and policy risk keep the regime tight through 2026. If the market gets a real supply shock, if gold stays bid, if physical tightness worsens, triple digits becomes a scenario the market has to price, not fantasy. We don't need to promise it. We need to prepare for it. What kills people in bull markets isn't upside. It's the swings. Here's the practical frame. Separate facts from interpretation. The note frames silver as deficit and policy-driven, not speculation-driven. It flags export licensing and constrained mine supply as tightening forces. It lifts targets for silver and gold into 2026. Interpretation. This is the market moving from trade to allocation. Allocation phases don't die quickly. They die when supply expands or demand breaks, which is more likely by 2026. Supply expanding fast or demand fading. Mines don't sprint. They crawl. Even when prices rise, production doesn't explode overnight. Projects take time. Permits take time. Politics takes time. Tightness can outlast patience. That's why volatility exists. The market is shaking out the impatient. Spreads mess with your head. When one market price is higher than another, that's not weird. In tight markets, it's signal. A spread whispers. One side is trading paper, the other is paying for metal. The pull to close that gap can be relentless as long as real demand lives. The question isn't are we at the high, the question is who's forced to buy next. That's the engine. Watch the cross-market tension. China's pull matters even when it looks small on paper. If Chinese futures trade meaningfully above the US, quote, that gap isn't free money, it's stress. The market saying one side wants delivery more than the other wants a screenshot. When that gap sits there day after day, traders don't close it with opinions. They close it with flow. Someone buys the cheaper side, sells the richer side. That buying pressure lifts the cheaper quote until the gap narrows. Price can look heavy right before it rips because the real force isn't mood. It's the gap trying to heal. If you're watching silver thinking, why won't it just behave? It's because two different markets are arguing about what silver is worth. The argument ends when metal moves. Positioning matters because it changes what happens on dips. In a normal market, dips invite sellers. In a tight market, dips invite predators. The predators aren't Twitter. They're refiners, fabricators, big money tired of getting caught wrong on the ratio. Here's a contradiction that should wake you up. Silver can drop on the screen while the real market tightens. Think of a parking garage. Half empty, you can drive fast, spin, whatever. Full, one bad turn traps everyone. A physically tight market is a full garage. Why does the $60 area keep coming up in put talk? Because that zone is where panic would likely peak if the market flushes. It's the level where weak hands finally believe the story is over. And in tight regimes, that exact moment is when the strongest hands get greedy. If silver dumps toward that zone, what would have to happen for it to stay there? Not touch there, stay there. Gold would need to roll over hard. Policy friction would need to ease. Physical premiums would need to relax. Spreads would need to stop screaming. If those don't happen, a dip is not a thesis break. It's a volatility event. Volatility events transfer capital from the emotional to the prepared. We're not gambling, we're measuring. Let's talk about what repricing really means. A repricing is not a rally. A repricing is when the market starts valuing the same asset with a different lens. Old lens, gold is a relic. New lens, gold is insurance. Old lens, silver is a cheap trade. New lens, silver is a scarce input with monetary optionality. When the lens changes, the whole range shifts higher. Not one candle, the entire map. UBS signaling higher targets into 2026 is saying the map is moving. Here's what makes this viral. The public still thinks silver is a meme metal, but institutions are starting to speak like it's a strategic metal. If gold keeps its bid and silver is tight, ratio pressure builds. People who ignored silver suddenly discover it. Funds rebalance. Algorithms chase relative value. How do we avoid being the person who shows up breathless at the end, buying the candle? We do something boring that works. We pre-decide our reactions. If price rips, we don't chase. We wait for a retracement that holds. If price dumps, we don't doom scroll. We check the physical signals. If spreads stay elevated and gold stays bid, we assume the regime is intact until proven otherwise. If you want a simple visual for entries, use penetration and retracement. Penetration is when price takes a level like it wasn't there. Retracement is when it comes back and asks, "Are you real?" If the level holds on the retrace, that's the slingshot. That's when trends stop being a line on a chart and start being behavior. You saw that when silver pushed through mid-70s and then held. That hold is where confidence builds, not at the top. The setup is tight market, policy friction, gold repricing, and a public that still thinks this is speculation. That's the imbalance that creates viral moves. Keep your eyes on the human tell. When mainstream voices start saying, maybe silver is different this time, that's not the top. That's the beginning of the stampede. First phase is denial. Second is curiosity. Third is FOMO. Fourth is regret. We want to be positioned before phase 3. I'm going to say something simple that saves portfolios. We don't need to predict the exact high. We need to avoid the exact mistake. The mistake is letting volatility convince us the thesis is dead when the structure is actually tightening. When the next punchy down day hits, and it will, don't ask why is it down. Ask what changed. Did physical signals change? Did policy signals change? Did gold change? If the answer is no, the move is probably a shakeout, not a reversal. Here's the trap. Volatility makes people beg for certainty, and the market sells certainty as bait. In metals, the perfect entry rarely arrives with calm. It arrives with noise and contradictions. Days where silver is down while the thesis is stronger. Build a simple checklist. Is gold still bid in this higher regime? Are spreads or premiums still elevated? Is policy friction still present? Do dips get bought near the ledge? If those stay true, the thesis stays alive. If those fade, we adjust. Think with me. If silver really is shifting from spec trade to physical regime, what breaks first? Miners because supply can't respond? Manufacturers because inputs get too expensive? Or the paper market itself because spreads and premiums stop listening to the screen? Drop your answer in the comments. What breaks first if silver pushes toward $85? And second question, be honest. When price rips, do you FOMO or do you freeze? Because whichever one you do, that's what the market will punish. The 2026 part matters more than people realize. When a bank says a tighter metal regime runs into 2026, they're telling you this isn't a one-week story. They're suggesting the structure is changing. The real game becomes, can we hold through the emotional storms without letting the tape bully us out? Because the market doesn't try to make us wrong, it tries to make us quit. And if this really is physical and policy-driven, the next move won't announce itself politely. It will show up as a gap, a spread blowout, or a sudden repricing that makes yesterday's argument feel outdated. Stay sharp, watch the ledge, watch gold, watch the spreads, watch the policy valve. If you want to stay on top of these shifts with us, subscribe right now, because the next time the market snaps, it won't wait for you. If silver pushes toward $85 and gold is aiming higher into 2026, what happens to the gold-silver ratio when the crowd finally notices the spring? That moment never feels like celebration. It feels like a stampede, and stampedes don't give refunds.